You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskins, your host. As always, this week we are swinging to the commercial market with Ray White's own Vanessa Rader. Vanessa, thanks for coming back in, mate.
Thank you.
It's been a few months, but the market cracks on in the commercial space. When we say commercial, we mean a number of things, right? We mean childcare, we mean industrial, we mean retail, we mean office. And the great thing about having you in here is that you can give us that national lens of not only how Perth's going, but how Perth's going in relation to the rest of the country. Because you might think, well, things are cracking on really well here, but actually things are going even stronger in Brisbane, or vice versa. It's a little soft here in the office space. Well, you should have a look at it. So
That's right.
Let's have a chat about that if we can for that context, and then just add a bit of colour to the various subsectors in the commercial space. And it might not be everyone's listened today. I know a lot of people are residential people when they listen here, but we also have a lot of commercial buyers, a lot of commercial real estate agents who love to listen to this segment. It's one for them.
That's right. And we're seeing more and more of those residential investors actually jump into the commercial market. So
Why do you think that is?
I think that in the quest for yield is really the point. We know that the residential market around the country, and in particular in Perth, has seen such huge growth. In turn, rents have also grown. However, just looking to diversify and looking for opportunities that may offer a better return, or may offer maybe a long-term cash flow position, which is what a lot of investors when it comes to commercial are looking for. Availability of finance is still pretty attractive for a lot of people. There's also a lot of cash buyers out there. So we have seen over the last, really since COVID, when the interest rates got really low, we did see a lot of investors pivot towards commercial, and that really hasn't slowed down.
Can I offer a couple of ideas as well to that? I think one, with the advent of real commercial and just the social media space, the commercial market is more accessible to people who have got the cash, who are generally or historically in the residential market. I think times gone by, you had to be a sophisticated investor, a wholesale investor, someone who was in the know or had friends or was in business to really have access to understand, what am I buying here? Secondly, as you sort of mentioned, that baby boomer market or cohort got a bit of cash these days. I think a lot of people get to that point in their residential investment journey where they get a bit tired of tenants trashing their house or negotiation on the lease every 6 months, and they just want to have that solid income, whether it's for 2 years, 3 years, or maybe 15 years in some cases,
that's
right?
certainly the case. That kind of long lease is very, very attractive, particularly long leases with fixed increases. So you have certainty over what that money's coming in the door. Also the outgoings as well. Outgoings often for commercial properties are all paid by the tenant, which is also really attractive. Maintenance of the property, refurbishment of the property, all that sort of thing then does fall in the hands of the tenant in a lot of the cases. So 100%, particularly when it's those long-term leases, and we call them kind of set and forget assets. And we definitely have seen a lot of people interest in those sort of assets over time. Also the availability of information, like you're not wrong there. Like it's not only just the real commercials of the world, but just if you just Google now to understand kind of rent rates or yields, or like that information is far more accessible today than it ever has been. And also growth in those buyers agents too. There's been a real shift with buyers agents, particularly in that commercial side of the business, really holding the hand of that investor, particularly first-time investor looking to pursue a commercial property investment for the first time.
I think you're right. The advent of the family commercial investor, if we can call it that, has come on with the hand-holding of the advent of the commercial buyer's agent. 10 years ago, I couldn't have named a commercial buyer's agent. Now, there's not as many as in the residential space, for sure, but there's certainly a number of them who are bringing opportunities, not only to family offices, but just people who have got $2 to $5 million in equity lying around, which isn't everyone, but it's a lot of people as well.
Yeah, it's more than you think.
Yeah.
They understand what's going on in the local market. They're often they're located around the country, so they have their finger on the pulse, if you like, of what's going on and those opportunities. And it's a real different dynamic to where it was, say, even 5 years ago.
Can I also posit that there are probably a lot of people who get into their 40s, 50s, 60s who have got some money and think, you know what would be cool? Owning a Caltex, owning a KFC, owning a Dan Murphy's. All these assets are actually, for the most part, at least by these companies and owned by a family office or just a wealthy enough family or an individual.
Yeah, that's certainly the case. And we've seen those brand names in particular because it's a big tenant. So you've got security over that income stream. Liquor, you mentioned, kind of laugh at it, but that's been our biggest kind of growth in terms of retail. Our fast food continues to grow. So yeah, why not own a Macca's if you can?
Yeah, and you can.
Yeah,
That's the
you can.
crazy thing, right? And one thing I think that we can just reference straight off the bat as well today is the differing yields that these different brands represent. And that really speaks to, I guess, the strength of that brand. So whilst you might be in fast food, for example, you've got a drive-through fast food box, the yield that you can expect to receive from a McDonald's will be very different to the yield you'd expect to receive from an Oporto, for example. Can you explain that?
Yeah, or also if you compare it to something like your local chicken shop, like there is some brand attraction there. There is some good faith and goodwill attached to those bigger brands. And so they tend to achieve better yields because the person that is buying that property has more confidence in that particular brand, and perhaps the terms of the lease are more attractive.
The strength of the covenant.
The strength of the and also the other thing as well is there's a lot of these, like think about your McDonald's. How often have you seen your local McDonald's actually move?
Never.
They don't.
I mean, I know my local in Morley has been there since I've been born.
So there you go. So they're the reasons why, and they're all the things that come into play when an investor is looking. However, how many times has your local chicken shop moved? So they're the sort of things that the investors do look at, and that there is a premium paid for that.
Exactly right. That's where I was about to segue to. That's probably the one risk factor a lot of people in the resi space get concerned about, is that whilst they'd like to think in the resi space, if they lost a tenant within a month, they'd have another tenant back, sometimes the next week. But in the commercial space, you do see commercial properties, especially in the retail and office and historically the industrial space, some have sat empty for years, like a decade. The office that we're in right now was empty for nearly a decade before we moved in.
That's right. And also to attract those tenants, you need to offer really high incentives, particularly if those vacancies have been there for a long time. So that really cuts into your income stream. Also, the agent fees usually for commercial property are far higher than you usually see in residential. So they're all the things that people need to factor in if they're looking at buying a commercial investment over a residential. There's a whole lot of positives in terms of, picking up the cost of those outgoings, for example, but then, there is additional expenses elsewhere.
Let's talk about some of the positives in the market from 2024 that we've seen. Inflation has been something that's impacted both sides. It's obviously increased the revenue streams, but also the costs of a lot of the tenants. We've seen a lot of rent inflation, especially in places like the industrial market, which is having massive impacts on the value of these concrete sheds. We've also seen interest rates impact or start to impact the yields that buyers are happy to pay for most commercial property across the different segments. Can you talk a little bit to that relationship and how that's affected yields in the different segments over the last 12 months, irrespective of the asset itself?
Yeah, I see what you're saying here, but the interest rate obviously is a huge factor because you have to be able to borrow funds to purchase this property. So the higher the interest rate went, the more difficult it was to... there needs to be that gap, that buffer between what the yield was and what the interest rate was. So therefore, we needed to see, just like we saw interest rates go up, we needed to see those yields kind of go up as well.
But it wasn't linear, was it?
It wasn't. It's really quite interesting. I've written a piece on it just last week, looking at what that growth has been and how much it's grown in the different asset types. It's really quite an interesting piece because the asset types that you think that it wouldn't have grown as much in, say industrial. We know industrial has actually performed quite well. It's actually grown greater in industrial than it has, say, in the retail sector. And that's because we've also had not only the change of cost in finance, but we've had this huge amount of rental growth in the industrial sector. So that to some extent offsets that change in the yield. It's really quite a hard one to explain. You probably have to show it. No, I need to put it on a chart and to kind of draw the lines on it. But interest rates obviously a key factor for people looking to buy. But when we're talking about these investors, a lot of these investors are quite cashed up. There's quite a lot of money still out there.
A lot don't need loans.
That's right. So that's why we're seeing sometimes those, particularly the small investment, probably trading below what you probably expect to pay in that buffer between interest rate and what the yield is. It's very, 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 very narrow, which historically it's never really been like that, but it's just a real change in dynamics of the way that the markets are operating.
Is that because their cost of capital isn't their interest rate? It's actually a term deposit maybe, or a treasury bond that is far cheaper than an interest rate?
That is certainly the case. And also I think that the investor that's in the market now, again, if we're going back to this kind of small investor market, they're long-term hold. They're not looking for, I'm going to buy this now, sell it in 2 years and make this huge capital gain. We're seeing a lot of investors and even owner-occupiers as well going, look, I need somewhere to either occupy or I want to buy an investment. I'm willing to pay a premium today, knowing in the future I might have capital growth based on gains in rental growth, and I'm happy to hold it for the next generation. So it really doesn't matter. I really just want to get in the market. It's a good location. There's a lot of other things going for it. So I'm happy to maybe sacrifice a bit of the price today for the growth further down the track.
To put it in plain numbers here, it's pretty much the case of someone going, look, I've got $5 million in cash. I've worked hard throughout my life. Well done to me, but I want a return from that. I'm not happy with the 3% I'm getting from the bank, 150 grand a year, right? How about I put it into a childcare centre, for example, or a petrol station or something like that, where I might get $300,000, double, and my risk tolerance is totally accepting of that entity, of that tenant. And that's how I'm going to fund my retirement. I'm going to park my 5 mil here, and I'm going to get 300 grand every year, increasing with inflation or some sort of review every year for the next 15 years. I mean, that's how you beat the market, really, isn't it?
Well, that's what we've seen. And that's what we have seen over the last couple of years. And that's why we haven't had the amount of volume of turnover in this last 12 months compared to previous years, because there's a lot of people out there looking to do exactly that, and the volume of stock just isn't available to meet those demands.
One thing that we also haven't considered in this conversation yet, and obviously it's early in this chat, but is the influence of owner-occupiers coming in, especially in, we referenced a couple of times, the industrial space. I think that's been a big changing of the guard in the last 12 months in industrial, and maybe there are other segments you can talk to in the commercial space that have done the same. Not that I've seen it. With the massive increases in rents we've seen over the last couple of years, it's probably starting to get a little bit tense for some tenants, especially those who are getting kicked out every couple of years. And therefore, what I'm seeing is a lot of people going, you know what, I just want to buy. I'll just take a big loan out and I'll buy it, and then no one can kick me out anymore. No one can raise my rent anymore, and it's going to be a family asset. Those people seem to be the people that are actually paying overs compared to investors buying a leased investment.
I totally agree with you, and it is a very industrial specific issue that's happening at the moment.
So it's not happening in other sectors?
No, not really. We're seeing some opposite actually happen in childcare, where we're seeing kind of those owner operators now opting for a leasing, but let's not talk about that. Let's just look at the industrial. So industrial, we're seeing there is lack of supply. There is lack of quality stock for a business to occupy.
To do business.
Like this is so, just say I'm a plumber and I need somewhere to put my pipes. So I need a facility, and my rent has gone up for the last 2 years, 25%, 18%. My property isn't actually that flash, but I can't complain about it because I don't want to get kicked out. So why don't I just pay whatever that premium is and buy it today? Get exactly what I want, maybe room for growth, maybe make it bigger or whatever it is.
I've seen my landlord make heaps of money off me in the last 10 years.
Why don't I buy it through my self-managed super fund? It's a family asset. It will stay here forever. And I'm happy to pay that little bit more today because I know I have certainty of my accommodation for the rest of my...
It's a business continuity thing.
100%.
And then in the future, it's a nest egg when I retire.
That's it, because they were going through doing business, everything's all great, but then all of a sudden your accommodation costs just went up by such a huge margin. That obviously impacts...
They've doubled pretty much.
It impacts the profitability of your business. So rather than just removing that uncertainty by just saying, okay, well, this is my new premises. And so you're exactly right. Vacant assets, as well as assets that are, even if they're leased assets and they've got a short lease or have the ability to kind of get rid of a tenant, we're seeing those owner-occupiers really swarm on those and being far more aggressive. I haven't actually seen that sort of dynamic happen in the industrial market ever before.
Well, I'm getting that feedback from local commercial agents, is that we're seeing exactly that, the owner-occupier being happy to buy an asset that's still got a 1.5 year lease on it and wait, and at least in a 1.5 years they'll have somewhere to move into. What about in the fuel convenience market? One thing I noted online a few weeks ago, I noticed is that yields are starting to pick up a bit, even to the point of about 7% in Perth, and that concerned me a little bit. We've saw them trading in the 5s, and we've seen East Coast assets trading in the 4s and even 3s.
3s, yeah, that's right. I think the biggest issue when it comes to those sort of like a petrol or fuel station is the lending. You can't borrow on a fuel station the same as you could borrow, say, on a childcare or on an industrial or something. So there's got to be enough people in the market that have deep enough pockets to actually be able to afford one of these assets. I think there was some concern with people around electric vehicles, and
that's what I think about as well.
But look, I think it's so far away. I think that a lot of the assets that are on the market, they're still blue chip tenants. They've got 10, 15-year leases in place. So if you're looking for an income stream, you're looking okay. We're seeing a lot of investors being a bit more opportunistic opportunistic. So perhaps they have a second tier or third tier type tenant, so not necessarily like big petrol tenants. If they decide to move, is there a development play? I know it's cost a lot to remediate land and stuff. There is consideration for that, but I think that that's got a lot to do with the kind of increase in the yields. But I think the financing piece is actually pretty strong. I think that
maybe just less buyers in the market.
I think there's less buyers in the market. I do agree that we did see petrol station buyers pivot towards the likes of childcare and fast food, because it just seemed a little bit more of a safer bet, if you like, and they had the availability to borrow those funds. I really think that's only the fundamentals of the market. But to be honest with you, the fact that yields have grown, so they should, because the cost of finance has changed. Like, do you know what I mean? So
right. It just seems like they've grown in that space more than probably any other segment at the moment. Let's go back to fast food again and talk in the context of this calendar year. I would have thought as cost of living has gone up, people have less money in the bank. The fast food joints would have been struggling a bit more this year, but it doesn't seem so. It seems like the expansion is continuing with a lot of these national brands.
Well, don't forget we've got population growth. So while you may look at that and say, oh, wow, people are obviously spending more money or there's more activity, well, there's more people here that are utilising the fast food facilities that there are. So there really isn't a whole lot of new construction. Let's just put that across the entire state, across every single asset class. The new supply of stock is being very, very limited. You've had very, very robust population growth here in WA. And at the end of the day, fast food is cheap eating options. And if you look at the retail trade numbers and you look at it line by line, all the different categories, that fast food component continues to grow, whereas that kind of cafe restaurant has slowed down a little bit. So there is different. The cheaper food, yes, people are still buying that. And also that population piece. I think they're the two indicators that are showing that we're still spending money in our McDonald's and Portos.
Well, I think the reason that we're not seeing a lot of construction in that space for all the assets we've spoken about is just the cost of construction relative to the rents that the tenants are willing to pay. Rents doesn't seem to have gone up as much as the cost of construction has gone up. When you think about what it costs to build, let's say, a grilled drive-through, over $2 million. It used to be a lot less than that, a lot less than that. And they're not paying that much more rent because they're not charging that much more for their burgers, but they're paying more for their staff as well. So there seems to be a squeeze along the way, and therefore when there's no profit in it for anyone along that line, we don't develop as much. However, there are still these brands that are really knocking the door down, asking, hey, have you got anything that we can move into? Just to make sure that their rollout in their territories, because once you're in, continues to happen.
Yeah, that's certainly the case. And the issue of the high cost of construction is not just the idea of the construction costs being high and the labour costs being high, but the number of builders. Where's that volume of construction businesses that are out there that actually can take on the work? And you're right, it is setting new economic rents, the rent that needs to be achieved in order to justify building that product. We know the land costs are high, quite a difficult one, but we're going to get to a point where that squeeze is going to come and we're going to start seeing construction. If you look at somewhere like Sydney, for example, across all asset classes, we really have had no construction over the last 3 or 4 years. And despite everything looking so expensive and so high, we're at that point where you pretty much need to start doing deals and start building things. But it will come at a point where affordability then is raised into question.
It goes all the way down to the bottom and the cost of a burger goes up.
Yeah.
Because it's the only way that the tenant can pay more in rent.
Then justify the rent. That's exactly right.
Yeah. So I think we're going to see that squeeze out the other side. What about the office space? Last time you were in, which is a few months ago, Perth space was ticking along. We had suburban centres that were actually doing surprisingly fairly well. The city's still struggling a little bit, but not as bad as the East Coast. It wasn't a great story, but also was nowhere near as bad as the rest of the country. What does it look like at the moment, getting into the end of the year?
Yeah, to be honest with you, not a lot has changed. I still rate Perth pretty highly on the office market compared to the other cities, particularly the East Coast cities. I think a lot has to do with this whole return to work issue, which is still being played through in markets like Sydney and Melbourne. There's been a lot more mandated going back to work. We know the New South Wales government came out saying that you need to go back to work. However, as much as you may see the headlines, they are not going back to work.
A lot of privileged staff as these days.
There's not a lot of bums on seats still. So therefore, if there isn't all these bums on seats, we don't need to expand our office holdings. We do not need to rent out more space. So we're seeing vacancies still track pretty similarly. There is no disputing though that this whole flight to quality, and I don't like that term, but there's nothing other way that you can really describe it. The premium end of the market and high A is where all the activities
It
happening.
has to just be because the pool's smaller. Otherwise, there wouldn't be a flight to anywhere. It'd just be everyone slots in where they can afford.
Yes, but the affordability is looking more attractive in those high quality assets because of the high incentives, and also to try to attract the people to come back to the office. So they might be taking up a smaller space but in a better quality asset.
Yep.
And that's to the detriment of the Bs and Cs and D grade assets where vacancies, I'm nearly at the point where I'm looking and going, I'm not sure what you're going to do here. Like, I can't see a time that we're going to be able to absorb the amount of poorer quality stock. And do we have to tear them all down and start again?
Therein lies the risk of commercial property. I mean, it's a perfect example, Vanessa, where you've got a solid asset in terms of the building is up. It's not falling apart. It still serves a purpose in terms of utility as shelter, but in terms of shelter for its use being office, it's redundant.
Historically, office has always been it has been really a trophy asset. It's been a landmark asset.
If you own an office, then you must be pretty rich.
Yeah, that's right. And all the offshore money was chasing office assets, particularly in a Sydney and a Melbourne location. And look at Melbourne, like half of the office buildings are, I don't want half, but I'm pretty negative of Melbourne, but there's a lot of vacancies sitting in Melbourne, some beautiful office buildings there that are sitting there vacant too.
A lot of for lease signs when I was there.
A lot of for lease signs, we've seen the signs in some of those regional, suburban markets rather, outgoings only. Like, who would have thought? Like, there's owners there that are just they're in distress. They just need to cover their costs.
Literally, can you pay my land tax?
Yeah. And the land tax went up in Victoria, as we know. It's a difficult time for some markets. I think that there's been such a structural change in the way that we occupy office. On a longer term view, I think that it's going to come back around. I think that we're going to need to occupy office space. I think that the talent pool is going to be reducing very quickly if everyone remains working from home. So people are going to be forced back into the office. So perhaps at that point we'll start seeing, well, there's no space left in the premium and A's, so we're going to have to take up those high Bs and
no one's
Cs.
building anymore.
No one's,
So
which it starts kind of bringing the question then, should we start building these premium and A grade buildings again? But then the cost, like we said before, is so prohibitive.
It's got to be refurbishments, Vanessa. Like, the structure of most C grade buildings are fine. It's just the utility within them in terms of how nice is the common area. Are there lifts? Is it walk up? What are the ceiling heights?
But it's also light and those sort of things. Sometimes it's very difficult to retrofit. Coming back to a Perth discussion, you're not having that same push with that work from home issue like there is in the East Coast. So I'm feeling far more optimistic on the office market here in Perth. Granted, you do have a lot of supply still. I'm not sure why we've been constantly building in Perth. But look, there's some good quality buildings. Vacancies are going to come down slowly. And also your population growth, there's a little more employment growth happening as well. So there will be
More
that
people,
absorption.
more workers.
That's exactly right.
And no tradies, as we know. So they must be going into white collar. Hey, 2025, if you could be owning one asset type within the commercial space, what would it be?
I'm going to go left field here and I'll say retail. Maybe a services store or a little neighbourhood centre or something like that.
Okay.
So we haven't been building retail, just like we haven't been building anything. Population has grown considerably. And as much as everyone thinks that we're buying online, we're not buying online. Our volume of online sales as a proportion has stayed pretty stagnant, with the exception of Black Friday sales. It might peak, but it's stayed pretty similar. Yes, we're buying our clothing perhaps online, but we're still wanting to go on services, our grocery items. There is a small proportion which is online. A lot of it's still you going into stores. So if you can have a retail centre perhaps with a supermarket and some specialties, particularly food related, like a butcher, a fruit shop, get your nails done, get your hair cut type situation where you can drive in.
Stuff.
Those things, I think that there is a huge need for that, and I think the local communities want that. So they will do quite well.
Especially with the flight to suburban activity centres again. I think we've definitely seen people wanting to engage more in their local communities rather than being sucked into the city.
Particularly when you look at those big major regional type centres, they're getting more and more holes in them, if you like, with larger vacancies. We know that department stores have either closed or shrunk their footprint. We're seeing the clothing type stores reduce as well. So what do you put in them? We're seeing far more those activity-based rock climbing walls, or it's not just the cinemas anymore, to kind of activate those areas for a longer term stay as well. So I think that that is a different prospect to what your neighbourhood centre is, which is something that's really convenient, get what you need to get and get out of there. Perhaps childcare can be in there, or medical could be in there as well. There's parking, it's kind of easy access. And at the end,
proof again.
And at the end of the day, these assets are generally on decent sized parcels of land which can possibly be redeveloped in the future. Perhaps you can put the supermarket back in or the stores in.
Apartments on top.
Yeah, like there is opportunity there. So the yields on those have gone up a little bit. We saw the likes of Stockland sell quite a lot of their assets, particularly in regional markets across the country, sub-regionally sort of spaces. So look, I think there's opportunity there. I think some retail strips are, again, it's very location specific, but if you can buy like a Dan Murphy's, like we started the conversation, those sort of assets are pretty damn attractive.
Do we agree that we expect interest rates at some point next year to be lower than what they are today?
Yes. We know that the results for November, they haven't moved. I feel pretty confident that there will be movement downwards next year. It may not be until May, but there will be movement downwards.
So in that space, when cash rate drops, interest rates drop, whether that's a loan and or the term deposits, therefore we expect yields to drop, but we don't expect them to drop in a linear one-for-one basis, just like they haven't gone up in a linear one-for-one basis.
Yeah, I totally agree, but I do have some trepidation around that just because we have seen this huge amount of private investor money coming into commercial property over the last little while, and I feel that as soon as there is that drop in interest rates, that might spark a little bit more activity in those asset classes again and fuel that change in yield. But I'll wait and see. I wouldn't expect it to drop, like you said, linear, but there definitely will be a change. But look, a lot of this is very location sensitive. I think that the investors that are out there now, they're very aware of market fundamentals and what's going on in specific markets. So they're not going to be running and jumping and buying something at overs. Like
it's not haphazard.
Not like we probably saw during COVID where, was this kind of push to who can get there first and buy it at the cheapest price. We're not going to see that again. I wouldn't have thought.
Burnt buying things at well below cash rate.
Yeah, that's crazy. It was a really crazy time to watch some of those secondary assets.
Yeah, selling for double what they were worth just 2-3 years earlier. And that doesn't really happen in commercial, right?
No.
It shouldn't really happen in
commercial. It shouldn't. And like at the end of the day, I always look at commercial should be a long-term hold too. So we've seen...
Based on rental growth, really.
Yes. But in somewhere like Perth, your dynamics of rents are a little bit different to other places. So if you look at industrial, for example, we've seen this huge uplift in rents. There is a lot of talk that the expectation is that those rents are going to start coming back down a little bit as we see vacancy start to increase.
Is that across the spectrum? Or in my understanding is the larger format industrial, pretty shallow pool of users, of tenants, of owners, therefore any real oversupply in that rents will go down. But the smaller stuff, still 12-to-1 in terms of demand to supply.
That's right. But if you look at historically the chart of rents for WA, there has been a lot of up and down. There's been up and down in those rents, whereas if you look at
a lot of down.
There has been a lot of down, and it has gone up a lot now in more recent times. But if you look at, say, Brisbane, Sydney, Melbourne, it's usually it goes up, stays the same for a long period of time, goes up, stays the same for a long period of time. Whereas you have
construction costs.
But you have this volatility which other markets don't necessarily have. I'm not sure though. Is the sophistication of the WA market has certainly grown, so perhaps we won't see the same level, but look, there is some expectation that there might be a bit of dip in some of those rental numbers for industrial.
Or your number 2 and 3 pick, if you could.
Anything that's medical, because our requirement for medical continues to increase. I probably wouldn't invest in it, but I think we need to build more aged care as our ageing population
We're
is there.
undersupplied on that, but I don't know that there's a solution in the
I don't know
market
yet.
for it
I don't know
right
if there's a
now.
solution,
It has to
but
be a structural change, like a massive government
initiative for that to happen.
or cash flow to solve this problem, because it will be the government's problem one day.
Yes.
I just don't think it's really hit them yet.
And I'll just do something a bit left field here, but it's a much bigger asset. It's the whole idea of the purpose-built student accommodation. Last month, I was in Vegas and attended student housing conference.
Is that what you were doing there?
Yes.
Okay.
I went and did other things as well, but I went to that. I went to a couple of conferences.
The only person to go to Vegas for a student accommodation.
Well, I was already going there. I just tacked on a conference and I spoke at it. And you wouldn't believe, so I'm sitting in Las Vegas on a panel of international investors from the UK, India, US, and also Vienna, that we were having a full-on discussion in the room about the Perth student accommodation market.
Specifically
Perth.
Why?
So it's a market that people know about around the country and how there is not enough supply of it.
Around the world, clearly.
Around the world. They, identify there is a need, which there is a need, and particularly with the government's thought of capping international student numbers.
Does that not dampen that then?
No, because what it really does is all it's doing is repositioning some states or some...
That sort of squashes it,
yes.
essentially.
So actually WA works out pretty well in regards to... Well, the students have to go to where they can go to a place. So the university will be given a cap. So each university is given a cap. So places like Melbourne, their cap is going to be down across their universities. Your cap is going to be up in WA. So that, and the cost to develop a student accommodation is far better than developing a resi, because you don't need to do all that underground parking and those sort of things. So
all the sexy stuff. Yeah, it's essentially a nice hostel.
Yes, it is. And the rents that they're achieving are quite outstanding. There is a lot of holding costs, obviously, and the taxation implications if you're an offshore investor. But just, I thought that would be really interesting. So I was sitting there thinking, seems so... They were talking about Perth and the Wollongong, which is like a regional market in New South Wales, Wollongong markets as potential places. Where am I to be sitting here, and for an audience of hundreds of people, hundreds of people talking about those kind of really local markets. So there's appetite.
Well, if you got a spare $100 million to build a student accommodation,
so that's, you asked me.
Go for it.
I've got, if I had that spare money, I'd be doing it.
What about refurbishing an office?
Well, refurbishing an office into a student accommodation, well, it has been done here, so it could be done.
It's not resi. The car park issue is not a problem. A lot of the services issues.
What about renovating a secondary office into some sort of storage facility or last mile logistic? Like, I know it has to be more of an outskirts, because access is going to be difficult. I heard a stat recently that people that do online shopping, nearly about half of all of the clothing purchases are actually returned.
Yep.
So somewhere for those returns to happen, and for that kind
I
of...
would believe that, seeing what my wife does every...
you just go buy in every size and you every colour, and you work out which one you want, and then it just eliminates you having to go into the store and doing that. So I don't know, I think there is some creative ways that we can try to solve some of that secondary office space, but it's going to require planning, government, local government really getting involved and being open-minded about what those solutions are.
Vanessa, thanks so much for coming in, mate. It's actually been a really fun conversation. I think even for those people who aren't commercially minded or not there yet financially, would love this chat. Really relatable, and something to look forward to going forward into next year at Perth.
Thank you.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!